Picture this. You bought a cryptocurrency at or near its all-time high. We've all done it. It's been going down ever since, and you're starting to wonder if it will ever recover. After all, the last thing you want is to hold a crypto until it's gone cold. And this begs the question of how you can know for sure that a crypto's time is up. Today, I'm going to tell you about a few criteria you can use to assess whether it's game over for a coin or token, so you're not left holding the bag when the bear market comes around. I know this topic is tense, so a disclaimer before we commence. Financial advice is not something I dispense. Just entertainment, education, and, well, a bit of common sense. Please contact a financial advisor if you need help with pounds and pence. Now, if this is your first time at the Coin Bureau HQ, my name is Guy and crypto is what I do. This channel is home to some of the highest quality crypto content on YouTube. Coins, tokens, news, and reviews are just a few of the topics I construe. If that sounds good to you, subscribe to the channel and ping that notification bell for more crypto truth. You can use the timestamps to skip around if your clock is ticking fast, but remember that watching until the end is the best way to make this knowledge last. Now, with all that having been said, let's look at how to tell whether a crypto is alive or dead. Step numero uno to assessing whether a crypto project still has a pulse is to check its long-term price chart on CoinMarketCap or CoinGecko. The first thing to look for is a long-term uptrend. In this case, long-term uptrend means that the coin or token in question is consistently setting higher lows. If price is in a long-term uptrend, then obviously this is a sign that the crypto you're holding is still alive and kicking. If the price is in a long-term downtrend, then this is a sign that the crypto you're holding might have an appointment with the Grim Reaper. This assessment is admittedly more difficult to do for certain cryptocurrencies, particularly those that have been around since before the previous bull market. Some of these cryptocurrencies saw their prices peak in 2017 or 2018 and haven't managed to regain their previous all-time highs. With cryptos like these, I reckon it's reasonable to pay more attention to what their price action looks like since the current bull cycle began, which is the start of 2020. If there's been a long-term price trend since then, you're probably A-OK. However, there is one big caveat to this first criterion, and that's that not all crypto pumps are created equal. Never mind that almost every cryptocurrency has rallied since 2020 because altcoins follow BTC. This means you need to dig down and find out exactly why the cryptos you hold pumped, and the easiest way to do this is to go to a crypto news site and search for the crypto you're holding. Make sure to load more headlines until you go all the way to the start of 2020 or earlier, and then check to see which headlines line up with the dates that the crypto you held started to pump. Now, in my experience, this searching is much easier to do on Cointelegraph and Decrypt due to how their sites are designed, but it's worth sifting through other crypto news outlets if you have the time. For lesser-known altcoins, you might not find any headlines at all, and if that's the case, then you'll have to check the Medium page or blog for that crypto project to see what updates there were when it pumped. If you find that the price pumps happened because of stuff like celebrity endorsements or sports team sponsorships, then this is a sign that the crypto you're holding might be a goner, because its previous pumps were based purely on temporary hype. If you find that the price pumps happened because of stuff like a meaningful partnership with a big company or an integration with another big crypto project, then this is a sign that the crypto you're holding could still be alive, because its previous pumps are based on more permanent fundamental factors. Now, on that note, if you're wondering how you can find cryptos before they pump, you can refer to my video about that using the link in the description. The second step to assessing whether a crypto project is still in the land of the living is to check how much runway it has. For context, runway refers to how much money the project has for its operations. Think research, development, marketing, and so on. This is important because a big part of a project's longevity depends on having enough cash on hand to continue growing, regardless of market conditions. Most crypto projects got their initial funding through an initial coin offering or ICO, and many have raised tens of millions of dollars in this manner. If the crypto you're holding only raised a few million or fewer and has already been around for a few years, then the project probably doesn't have much runway, and that's a sign that it could be on its way to the grave. If the crypto you're holding raised tens or even hundreds of millions and is relatively new, then it's safe to assume that it has lots of runway, and that's a sign it's just hibernating until the next bull phase. Another way crypto projects get funding is by selling coins or tokens that were allocated to the team at the ICO stage. Now, the brutal truth is that the teams and companies behind just about every crypto project have been selling aggressively over the last year or two. This has suppressed the price of many cryptocurrencies in the short term, but if that capital is put back into expanding a crypto's ecosystem, it can result in even bigger gains in the future. Now, you can use the Profile tab on Masari to see what the initial allocation and vesting schedules are for your favorite cryptocurrencies to get a sense of how much went to the team and company and when. If you compare these vesting schedules to the price action of the crypto you're holding, chances are you'll see that prices tend to drop around the time that coins and tokens unlock. In some cases, you'll have enough information to calculate roughly how much money the team has made from selling their allocation over the years, and sometimes they're transparent enough to publish this information on their website or the website of the foundation behind the project, if applicable. Do note that if you can't find any information about vesting schedules or team selling anywhere, then that is a red flag, assuming, of course, that it wasn't a fairly launched crypto. It's also a bad sign if it looks like the team and early investors have cashed out completely. Now, the final source of capital for crypto projects tends to be post-ICO funding from venture capitalist firms. Lots of post-ICO funding can be seen as proof that the crypto project is solid and is likely to be around for a long time, regardless of its current price. So, if your crypto project has lots of it, there's no cause for concern. This info can again be found on the project's Medium page or blog. If you're curious about which crypto projects have seen the most post-ICO funding, you can check out my video about that using the link in the description. The third step to assessing whether a crypto project is still going strong is to check whether there is still development being done. This is because of one simple principle. If you build it, they will come. A crypto project can have a long-term uptrend and lots of runway, but if nothing is being built, well, then it's only a matter of time before it shuffles off this mortal coil. That's simply because there needs to be some fundamental driver of demand for the coin or token, something that makes it stand out from its competitors. Ideally, the crypto project you're looking at will have a roadmap with clearly defined milestones that are both attainable and meaningful. Now, I don't know who needs to hear this, but an upcoming NFT marketplace or metaverse world doesn't count as meaningful unless you're dealing with a crypto that was specifically designed for the NFT or metaverse niche. If you see any niche overreach, prepare to say your piece. Meaningful crypto milestones include stuff like a mobile wallet or browser extension wallet, cross-chain bridges to popular cryptocurrencies like Bitcoin and Ethereum, upgrades that improve decentralization, speed, or security, and mainnet launches. If you see this, you can sit comfortably with your bag. It's not good enough to have a convincing roadmap, however. There needs to be measurable progress being made towards its milestones that you can clearly see. Because most crypto projects are open source, you should be able to see this progress taking place in real time on GitHub. If you scroll down on the homepage of a crypto project's GitHub, you'll see a list of repositories with recent activity, along with a one-year history of activity, which is what's on the right-hand side. If you click on View All Repositories at the bottom, you'll be able to see every single one. And even if, like me, you don't know how to code, the title of the repositories alone should give you a rough idea of what's being worked on and how much progress is being made. If you're lucky, the crypto project you're following will post regular updates on social media or elsewhere about how close it is to meeting its upcoming milestones, and you may even be able to ask the developers directly as to what's going on. If you can't find a GitHub, or if the repositories have next to no activity, or if there are no updates from the team whatsoever, and the developers leave you on read regardless of what you ask, your crypto might be as good as gone. If you find a GitHub with lots of activity, ample updates from the team on every social channel, and developers who respond to your inquiries, you might be unknowingly holding the next hot altcoin. The number of developers working on a crypto project matters too, and you can find out which ones attracted the most over the last year by watching my video about Electric Capital's Crypto Developer Report, using, of course, the link in the description. The fourth step to making sure that a crypto project isn't pushing up daisies is to check whether its community is still intact and engaged. There are many ways you can measure this, and my favorite way is to check the Google search trends for the coin or token you're holding, or even just the crypto niche it's a part of. Right now, almost every crypto-related search term is in the toilet, but I reckon you can read these charts in much the same way as price. If you see a long-term uptrend, then it's a good sign of life, however small. If you see a sudden spike, followed by a long silence, that crypto is probably on the road to extinction. Note that it's worth being a bit more generous with the definition of an uptrend, given that you're not dealing with price. As far as search trends go, significant sustained interest over a long-term period is what you want to see. A similar social metric you can use is the amount of engagement on Twitter, Telegram, or Discord. If you're seeing lots of likes and retweets on Twitter and constant discussion on Telegram or Discord, then reports of the death of your crypto might be greatly exaggerated. If you're seeing next to no likes and retweets on Twitter and no discussion on Telegram or Discord, even when you try and get one going, then I'm afraid your crypto could be headed to the great repository in the sky. That said, search trends can be deceiving, and social media tends to be the tip of the iceberg, which is why you should put the greatest emphasis on what you see on-chain. If the crypto you're holding is related to a decentralized application, you can use a website like DappRadar or Dapp.com to see how many active users it has. Naturally, the more, the merrier. If the crypto you're holding is related to a DeFi protocol, you can use a website like DeFi Llama or DeFi Pulse to see what the total value locked on it is. And you can even use the TVL wave as a de facto indicator like price and search trends. Long-term uptrend good, long-term downtrend bad. If the crypto you're holding is a layer 1 cryptocurrency, you should be able to find an explorer that will show you how many active wallet addresses there are and how that trend is changing over time. Same principles apply. The number of daily transactions is an equivalent on-chain indicator, as is the average transaction fee. Logically, higher fees mean more activity. If the crypto you're holding is a token on a blockchain like Ethereum or the Binance Smart Chain, you can use Etherscan or BSC Scan to check how often the token is being moved and to where, how many wallets hold the token, and whether wallets are dumping or accumulating. Now, these are just a few of the on-chain elements I keep track of, and you can learn about the others using the link in the description. The fifth step to assessing whether or not a crypto project is sleeping with the fishes is to check its tokenomics. Make no mistake, a cryptocurrency could tick every other box on this list, but if its tokenomics are trash, it doesn't stand a chance. And this is a scenario I've seen play out time and time again. Generally speaking, cryptocurrency tokenomics fall into two categories: infinite supply and maximum supply. The advantage of cryptocurrencies with no supply cap is that the constant inflation creates the incentive required for validators or miners to secure the network and process transactions indefinitely. The disadvantage of cryptocurrencies with no supply cap is that the constant inflation tends to do serious damage to the price of that coin or token, especially during bear markets when demand is low. If the crypto you're holding has no maximum supply, you need to make sure that this inflation isn't too high, or else it may continue to crash until the bulls come back to town. And you may not want to hold through such conditions, even if the project itself is legit. Alternatively, you could choose to stake your crypto if that's an option. Just make sure to double-check the lockup or unlock period isn't too lengthy, because otherwise you might not be able to sell when prices start to pump. Note that it's important to factor the vesting schedule into baseline inflation when making this assessment. Crypto projects often omit vesting when calculating inflation to give the illusion that the supply shock isn't as bad as it seems. Now, at the other extreme, you have cryptocurrencies with a maximum supply, and the advantage there is that the price of the coin or token in question is very likely to rise, at least on a long enough time frame. The disadvantage is that reaching this maximum supply may not always be desirable because there's no incentive for miners or validators to continue securing the network or processing transactions. In theory, transaction fees will be enough to sustain these kinds of cryptocurrencies, but in practice, it's rather questionable as we've yet to see any cryptocurrencies pull this off. So, if the crypto you're holding has a maximum supply, you need to make sure that this maximum supply won't be met for many years, or make sure that there's some mechanism in place that will continue to incentivize miners or validators once that maximum supply is met. It's also worth taking some time to assess how this coin or token is distributed. If a disproportionate amount of its supply is being held by just a few wallet addresses, then you might be dealing with a shitcoin. If you want to know how to spot a shitcoin, my shitcoin checklist video can help you with that. Link in the description. Now, to wrap things up, I want to fire off a few other factors that could signal the end of the crypto you're holding. You can think of these as being the common characteristics of a bad cryptocurrency. So, firstly, extremely low trading volume for a long time, possibly followed by sudden spikes in trading volume. This is the telltale sign of a pump and dump as far as I'm concerned. Secondly, limited exchange support or trades only on decentralized exchanges. In my mind, any quality cryptocurrencies that have been around for more than a few months are bound to list on a good exchange like Binance, Kraken, Coinbase, FTX, or KuCoin. There are very few exceptions here. Thirdly, exchange delistings. Now, this is something you don't see very often these days, but if we enter a prolonged bear phase or even a bear market, then it could become commonplace, particularly if the SEC starts cracking down on altcoins listed on US exchanges. Fourth, core team members, developers, advisors, or investors pulling out completely. While there are cases where crypto projects have recovered from this kind of attrition, it's extremely rare and should definitely be interpreted as a death knell. Fifth, constant technical issues with the base chain or any applications used to interact with it. If a crypto project can't keep its stuff fully functional even when nobody is using it, then price action should be the least of your concerns. Sixth, the absence of a website, documentation, white paper, or other resources required to understand how the crypto project works, who's behind it, and what it's all about. Pretty self-explanatory as to why that's a problem. Seventh, the coin or token can't be found on CoinMarketCap, CoinGecko, or other crypto tracking sites. If you're in that deep, then you're not investing, you're gambling, at least in my opinion. Eighth, it's on the radar of regulators like the SEC. Now, this isn't the be-all and end-all, but it can be if you're not careful. Hint, anything that preserves privacy is probably a target. Ninth, anonymous developers or a notable lack of transparency. These tend to go hand in hand, and while not all crypto projects with anonymous developers are bad, it arguably raises the risk of something going wrong. And last, but not least, you bought the coin or token purely because you were put under the impression by a friend, family member, or celebrity that it would pump. If this is the case, you need help, and you can find it right here on this channel. I recommend starting with my video about how to find the next 100x altcoin, and it'll be waiting for you down in the description. Folks, always do your research. No excuses. Don't make me come round there. And that's it for today's video about how to tell when it's time to bail on your crypto bags. If you found it helpful, give that like button a tag. Remember to subscribe to the channel and ping that notification bell too, because you don't want to miss the next video that hits the tube. If you're looking for more from this dude, I've got a few things for you. My second channel called Coin Bureau Clips, where I post behind-the-scenes footage and original flicks. My podcast with iHeartRadio, which is available on just about every podcast-related platform. I'm always active on Twitter, TikTok, and Instagram, and I let you know what I'm seeing in the crypto market on Telegram. My weekly newsletter is crammed with information that will help your portfolio heal, and I've also got no shortage of crypto-related deals. You can get a load of those and all the other resources I just proposed using the links down below. Thanks for watching, everyone. It's been fun, but this guy's gotta run.